Hi everyone, this is Alpesh Parmar. I would like to introduce Jeff Dixon from UDirect IRA on the call. As most of us are not aware how we can use our IRA money or 401k money and self-direct, and the way it works is that we can use that money and invest in alternative investments other than Wall Street, like real estate or precious metals, etc. I wouldn't take a lot of the time on the call, as I would prefer to have Jeff go through the presentation. I sincerely appreciate that Jeff has was able to join the call today, has taken out some time out of his weekend for us. So I'll introduce you guys to Jeff. Jeff, you can carry on now. Thank you.
Okay. I appreciate that. Hi, everybody. I'm with UDirect IRA Services. We are a self-directed IRA company, which means that we help people who want to invest their retirement funds into alternative assets, things outside of the stock market. So just a few things up front. What we don't provide is legal, accounting, or investment advice. So we can tell you how this works, but if you wanted to find out specifically how buying a piece of property, what the tax ramifications might be on that, there's really none. But if you have specific questions, you actually need to talk to someone in that industry, because we're not able to give you advice in those arenas. So just so we're clear on that. It's funny. Alpesh was saying that a lot of people don't know about this, and sadly, that's true. Only 3 to 4% of all retirement funds are in self-directed accounts, which for us, means there's a lot of upside. There's a whole bunch of people out there that could open up accounts, but it's kind of the big secret in the retirement industry, and there's a couple reasons for that. The main one is really the main players in the retirement industry aren't going to be telling people that they can do this. The Charles Schwabs, the TD Ameritrades, your bank, they're not going to tell you that you can self-direct. I mean, if you ask them, they might give you an honest answer, although not all of them will. But, they're going to basically tell you what you can do with stocks, bonds, and mutual funds. And it's not because the IRS says that's all you can do. That's all they want to offer, and so that's what they're telling you that you can take advantage of. But there's a lot of other things that you can do. So financial planners, stockbrokers, they're not going to tell people about this. They make their bread and butter. They make their money off of commissions of buying and selling stocks or bonds. They have no motivated interest to tell people about this. And not even very many CPAs or attorneys are very knowledgeable about this. We get calls from attorneys and CPAs all the time, and some of them have never even heard of this before. I mean, it is kind of the big unknown secret. But you've been able to do this since the mid-'70s. Let's click forward. So what's the difference between a typical IRA account and an IRA account with us? Well, from one perspective, absolutely nothing. We're all governed by the exact same IRS rules. There's no difference on contribution allowances, distribution requirements, prohibited transactions. The only difference between a Charles Schwab and us is the type of assets they let you hold versus what we let you hold. So our clients invest in rental property, notes, private stock, LLCs, tax liens, apartments, pretty much anything that's legal and is outside of the stock market, people can invest into. And occasionally I have some people chuckle like, legal. And I'm like, legal is kind of an interesting aspect right now. Medical marijuana being a really, topic that's a forefront. Some states have actually legalized medical marijuana, but the federal government hasn't. And IRAs are actually regulated by the feds. So it doesn't really matter what a state themselves has allowed. The feds themselves are the ones who dictate what you can do with this. So it does have to be something legal. Move forward. Now, Losses do occur occasionally within an IRA. It's unfortunate, but sometimes people do make bad investments. And it's important to keep in mind that just like if you bought a bad stock and it went down to a zero value, if you decided to get into an alternative asset and it was not the right one for you to get into and it became a zero value asset, you're going to lose your money with it. And you can't write that off on your tax returns. Any losses within an IRA are not something you can, write off, just like the profits aren't something that you're having to be taxed on. So what is it that you can invest in? Well, it's actually easier to tell you what you can't invest in. So the IRS says you cannot invest in life insurance contracts and you can't invest in collectibles. Collectibles are like guns, cars, painting, wine, things like that. Now, as a practical matter, you also can't invest in S corporations. It's not a specific prohibition. It's just that the only one who can invest in an S corporation is a live person. And since IRAs aren't live people, they're by default prohibited from getting into an S corp. Go ahead. Now, if you have 401k funds where you're currently working at, you're probably not going to be able to move those at this point. Generally, you have to have left employment in order to be able to move 401k funds. Occasionally, they do allow it. When they allow it, it's called an in-service transfer. It's more likely it's allowed if you've hit 59 and a half. Most of the time, since you can start taking your distributions at that point, a lot of the companies will let you go ahead and move the money. But if you're younger than that, you can ask if it's possible, but don't be surprised if they say, no, you can't move it until you're no longer working with us. So disqualified people, not only are there things you can't invest in, there's people you can't interact with. And these are called disqualified persons. So your disqualified persons are yourself and your spouse, if you're married, and then your lineal ascendants and descendants, like parents and grandparents going up, children and grandchildren and their spouses going down. So your IRA is not able to interact with these entities. On a practical matter, what that means is you can't make a loan to yourself or your business or your wife's business or buy a property from your parents or buy a property and have your kids rent it out. Your prohibited parties, your IRA can't interact with one exception. And I'll get to that in a second. But as a practical matter, if you're going to be working with a transaction, you need to be finding parties that are not prohibited parties to you that your IRA is going to be interacting with. The one thing you can do with a prohibited party is buy new assets together. So, for example, your IRA and your dad could go buy a new property together. Now, once you've bought it, you're prohibited parties to each other, so you couldn't buy each other out at a later point in time. All you're going to be able to do is buy it, own it, and sell it together. So qualified people, is pretty much anybody else. Your aunts and uncles, your cousins, brothers and sisters, nieces and nephews, and then, of course, anybody else that's not related. Now, the thing that's really important, though, to keep in mind with someone who is considered a qualified person is what is the ultimate intent of what your IRA is trying to accomplish. For example, you can't make a loan to your own business. You're a prohibited party to yourself. But you could make a loan to your brother. He's not prohibited. But your brother couldn't turn around then and put that money into your business. You can't end up with constructive use of your IRA funds. And it doesn't matter if you put your brother in there as an intermediary. All you've done, the IRS just considers that to be a straw transaction. So if they find out about it, it's no different than if you had made the transaction directly to your business in the first place. So it's important when you are dealing with close family members that you're not doing it as a way to try to circumvent rules, because that's not permitted either. Move forward. So we're going to cover a lot of information here, but if you really want to find out about specifically from the IRS, it's IRS Publication 590. That's the one you'd actually want to read. It's written like most government, paperwork. It's kind of long and tedious. I'm trying to make a better job of presenting it to you, but it is there for you to use as a resource. You can't borrow from your IRA. You can't sell property you already own into it. You can't use it as security for a loan. You can't buy property that you plan on using personally with IRA funds. Any of these investments, you're not going to be able to get personal use out. Go forward. So neither you or any disqualified person can benefit from the IRA. And that kind of gets back to, I said, you couldn't buy a property and have your son rent it out or your kids rent it out. They can't benefit from it. So you need to make sure that the transactions you're interacting with are not close family members. You can't provide goods, services, or facilities to your IRA account. So let's say you're a real estate broker and you want to buy real estate, and you're thinking, well, this will be great. I can, get a commission when my IRA buys a piece of property. It's a great idea, but it's not going to be allowed because you can't provide goods and services to your IRA. So you can't represent the IRA as a real estate agent. Or if you needed to drop a contract and you have, you're an attorney, you can't draw up that attorney or drop that contract, using your law firm. You're not going to be able to have any personal benefit out of what your IRA is interacting with. So, it's a little frustrating, but it is a rule, and you're going to have to use third parties to do these transactions for you. If you're a contractor and you think, well, this will be great, I can fix up the properties my IRA buys. And no, you can't. You can't provide services to your IRA. The indirect rule we already covered, that's using a third party. So what's the structure here? You've got yourself, you're the client, you have your own IRA with us. If you're using us, we're UDirect IRA. We're called a third-party administrator, and we have a relationship with the trust company. That's the custodian that holds the funds. And some people ask what the difference is between a third-party administrator and a custodian. The big difference is that custodians hold funds in assets. Third-party administrators don't. What we are is a point of contact. So you do all your interactions through us, but we don't actually hold on to your funds. Go ahead. So if you're buying real estate with an IRA, what's great about it, and it's true of any asset really, there's no capital gains. This is all tax deferred. The cash flow, it's all tax deferred. It doesn't matter how long you hold the property, 6 months or 6 years. Your IRA can actually borrow money, and we'll talk about that a little bit later down the road. But the reason people look at doing these types of alternative assets is they think they can get a better rate of return than what they might be able to get in the stock market or with more traditional investments. If you don't think it's going to be a better rate of return, this may not be the best opportunity for you. But it really just depends, and that's a question we get asked fairly often. Well, what kind of return can I expect? I don't have the vaguest idea. Depends on what you're going to invest your money into. Because unlike a regular stockbroker that might have mutual funds or something that has a rate of return on it, we're not offering you an investment opportunity. All we're doing is holding your IRA account. You're going to find whatever investment you want, and the rate of return will then be based on that specific investment you're interested in. So we couldn't begin to tell you what your rate of return would be because we don't know what you're going to invest your money into. Go ahead. Now, there are some nice features of owning real estate outside of an IRA, but you're not going to be able to take advantage of those within an IRA. You're not going to be able to write off capital losses. You can't, when you're filing your Schedule E on rental income, you get to write off all the expenses and depreciation. You're not going to be able to do any of this with an IRA because you're not filing a tax return, one, that's even going to be having an opportunity to write all this off. Just like if you bought stocks and it went up dramatically in value, you don't pay capital gains on that either. There's no difference here. It's just a different type of asset class. Go ahead. So I mentioned that an IRA can take out loans, and that's true. It's called a non-recourse loan. And what that basically means is if the lender has to foreclose, all they can do is take the property back. They can't go against other assets in your IRA, and they can't go after you personally. And you can't personally guarantee the loan for the lender. You're going to find most banks and mortgage companies actually won't make a loan to an IRA. There are lenders who do. It's generally private companies, hard money companies, although I do know a couple banks in the Midwest that have carved out a niche into this. But generally your down payments are larger, 40 to 60%. Your interest rates are higher, 6 to 12%. These aren't Fannie Mae secondary market loans that you get, trying to go who has got the most competitive deal. These are very, very specific transactions. But here's the more important thing to keep in mind with that. Typically, when you buy property or buy an asset with an IRA, the profits are all tax deferred or even tax exempt with a Roth. But when you use financing, the IRS will actually tax your IRA. It taxes the IRA on the portion of the deal that was acquired with the financing. So if you put down 50% and borrowed 50%, 50% of the rents each year are actually taxable. Your tax return is going to start filing a tax return, which is called a 990T. Now, that doesn't mean the deals necessarily become a bad deal, but it is something you want to make sure you understand so you realize what you're obligating your IRA. Go ahead. We've already talked about this. The tax itself is called Unrelated Debt Financed Income Tax, UDFI. So, yeah, that's what it's actually called. It's what you'd want to talk to your tax advisor about if you wanted to get into using financing. Go ahead. Now, there's also a second tax that an IRA can be assessed, UBIT, Unrelated Business Income Tax. And that's if an IRA is actually involved in running a business. Now, sometimes that's real easy to ascertain. If your IRA bought a dry cleaning business, for example, it's running a business, and it's going to be subject to UBIT tax. Now, sometimes it's just a matter of the amount of activity you're doing within a specific transaction type. Flips are most notable for this. The IRS has actually gone after people because for doing a substantial number of flips in their IRA each year, saying that all they're really doing is running a business out of their IRA. So how many is too many? Well, thank you, IRS. They won't tell us a specific number. They won't say, 5 is okay or 10 is okay. So you kind of just have to be very cautious with this. We generally recommend you don't try to do 2 or maybe 3 a year. Keep it very conservative because otherwise you might actually be subject to that UBIT tax. And like I said, you're going to file the 990T, excuse me. So what's the process here? You open an account with us, you're going to find the property. Now, here's how it differs from buying property outside of an IRA. We sign the contract on behalf of the IRA. You can't obligate your IRA for anything. So where you would have signed a contract if you were buying it personally, you can't do it that way with an IRA. You're going to find the property and negotiate the price, but we sign the contract. And so you fill out a bi-direction letter for earnest money, or if you need us to sign the contract, anything you need us to do, you have to put into writing to us so we have a record of your request for that. But that's the big key. You're not going to be able to sign anything. We do. And monies are all going to come from the IRA. You're never going to use personal funds. And that's probably the biggest mistake that we see, especially with newer clients. We'll get a contract that shows up in our office. It's in the client's name, they signed it, and they wrote an earnest money check out of their own pocket. Well, they've already done 3 prohibited things. And there's no way to fix that other than just to void it, return funds, and start over. Because you can't assign that contract over to your IRA either. Once you've signed it personally, your IRA can't get involved. Now, some people are like, well, I'll just do it and then I'll void it out and start over. That's not a big deal, and it may not be a big deal, but the seller doesn't have to agree to let you start over. So it's important you understand who you're talking with, because they could require that you finish the original contract or lose your earnest money. So it's just easier to do it correct the first way. Once you've bought the property, title's held in the name of the IRA, rents are made payable to the IRA, and the IRA covers all ongoing costs. Again, you're never going to use personal funds. Go ahead. So, father and son buy a house. Like I said, even though they're a prohibited party, a father and son could buy new assets together. The dad uses cash, although he could also use an IRA if he wanted to. The son's using his IRA. So title reads, custodian for the son's IRA 50%, the father's 50%, tenants in common. Tenants in common is the only way that multiple people can own property within an IRA account. Can't be held any other way. It's going to have to be tenants in common. Go ahead. So the reason that this is allowed, before the deal, neither the father or the son had any ownership in that asset. So they're not prohibited to each other yet. So the disqualified person rule doesn't come into play here. Go ahead. But afterwards, the disqualified person rule does come into effect. So neither the father or the son can live in the condo because the father's disqualified to the son's disqualified to himself, and no one else who's a disqualified party to the son can get into the property either. So they can get into it together, but then the prohibited party issues all come into play. Go ahead. Father or son can never buy anybody out. We covered that already. So what if the IRA runs out of money? Because, like I said, the IRA has to be able to cover all the expenses. Well, if you're allowed to make your annual contribution, you can do that. Maybe you have other assets in the IRA that you could sell and liquidate back to cash. If you've got other retirement plans you haven't moved over yet, you can look at accomplishing that. You could bring on a partner by selling part of the asset to someone. The IRA could try to get a loan, or if nothing else, you might have to completely sell the asset. So it's important to make sure that the IRA has enough assets to be able to maintain a property after it's purchased. Go ahead. So I talked about how the IRA is the entity, or that we sign on behalf of the IRA. And that is true. However, there is an option that some people take advantage of called an IRA-Owned LLC. It's kind of called a Checkbook IRA in jargon terms. And this is what's actually happening here. So you're still opening an account with us. You're still moving your funds into that account with us. But then you're going to do an additional step. You're going to have a third party create an LLC that the IRA owns and that the client's the manager of. They can't create the LLC themselves because they can't provide goods and services to their account, so they have to have a third party do this. They can't use an existing LLC because they can't put anything into their IRA they have current ownership of, so it's got to be a new LLC, and it's created by a third party. Now, once this LLC is created, the operating agreement is sent to us. We sign on behalf of the IRA. The IRA has now bought and owns that LLC. What it pays for the LLC is the money that's in the IRA account. The client will open up a checking account under the name of the LLC, and then we'll move the money from the IRA account into that checking account. So now when someone wants to buy the property or any asset, They buy it in the name of the LLC, not in the name of the IRA. But they can sign all that paperwork as the manager of the LLC, and they now have funds in that checking account that they can send out on behalf of the investments. So they no longer need our review and signature, and they no longer need to ask us to send out money. Now, it's kind of like that old Spider-Man adage, with great power comes great responsibility. So, suddenly they can do things without custodial review and approval, but that doesn't mean that, that they're able to do things that they are prohibited from, and they need to make sure that they're following all the rules. And if they have questions, they should call us. Ask us up front if they should or shouldn't do something. We'd rather they talk to us than make a mistake and suddenly have a big mess on their hands. Go ahead. So there's 3 different types of plans out there. There's IRA accounts. There's qualified plans, which are ERISA controlled, and those are basically like 401ks or 403bs. And then there's some other types of plans that you can self-direct, like education or health. We're actually not doing those at this point. So what we can help with are IRAs, and then there's also what's called a solo K that I think we have a slide on a little bit down here. So let's go forward. Yeah, that just kind of covers that same information. Go ahead. Well, let's talk about the solo K for a second, because I'm not sure if there's actually a slide on that. So not only do we offer IRAs, we offer a solo K. And the solo K is a 401k plan for self-employed people with no full-time employee. So if you're not self-employed, it's not an option for you. If you have full-time employees, it's not an option for you. So what's the difference between a 401k, a solo K, and an IRA? Well, they're governed under different sections of the tax code, but they have a lot of similarities in terms of the prohibitions, in terms of the assets that they can hold. But here's the differences between the two. The solo K has much bigger contribution limits than an IRA does. You can put both pre-tax and after-tax contributions into a solo K, where you'd actually need 2 different types of accounts. With IRAs, you'd need a traditional and a Roth to do the same thing with IRAs. You can take a loan against a solo K, where you can never take a loan against an IRA. And you might recall me mentioning that tax, UDFI, where you use, when financing comes into play, that an IRA is assessed. The solo K is generally exempt to that tax. So there are some benefits to the solo K. It's a little more expensive to get set up, not dramatically. It's going to cost about an extra $400 to get set up. The ongoing costs are the same. And it very well may be a better plan for you. It's something you'd want to talk to your tax advisor about. Go ahead. So what would you want to do if you want to move forward? You're going to complete an application. Depends on the type of account you want to open. We also need a copy of your driver's license or passport and a copy of your latest statement on the account you're moving over. You're going to fund the account from moving over funds from your existing retirement plan, or you can make an annual contribution into it and start it up that way as well. And then you're in a position to start investing. And you're going to go find the investments, and you'll then tell us what you want your IRA to get into. Go ahead. So anyway, that's basically the information. I'm happy to try to answer any questions if we have that ability here. This is all my contact information, and I'm always happy to talk to anybody.
Okay. So, yeah. Thanks, Jeff. I don't think there are any questions, but I have some questions, basically on their behalf.
Okay.
So how long usually does the process take, right? What have you seen between, on average? If I decide to, let's say, I have an IRA with a third-party custodian or Chase or someone else, how long is the and I want to move to, let's say, you direct IRA, How long is the process
Well,
on average?
yeah, there's not a simple answer to that because there's several variables involved. If it's an IRA that's getting opened up, the IRA itself can generally be opened in a day or two. That's a very simple process if we get a completed app. The Solo K will take probably 2 to 3 weeks to get set up. It's a much more involved process. And then it depends on where the money's currently at. Some custodians are more difficult to get money moved from than others. Fidelity is actually pretty easy. Schwab is pretty easy. But there's some financial institutions out there that to move money, they require that the client go get something called a medallion stamp. And a medallion stamp is a signature guarantee, and you get it at a bank. But not all banks offer it. But if they have a requirement that you need a medallion stamp, you actually have to find a bank that will offer it to you. So it's used for fraud protection because basically you go into a bank and you prove your identity, and therefore when this form shows up to move the money to the custodian that has the money, they know it's coming from you, or at least they've got a good comfort level of that because it has this medallion stamp on it. But sometimes getting a medallion stamp can be challenging. I mean, I've had several clients call me up after a period of time and say, I cannot find any bank that will offer me this. And they've really only got 2 choices at that point in time. They can keep looking, or they can do what's called take a personal distribution of the funds. Because generally these same institutions don't require that you get a medallion stamp if you're asking that the money be sent straight to themselves. So if they take a personal distribution of funds, you might think, well, then I'm going to get taxed, aren't I? And you would if you don't turn around and put it right back into a retirement plan. You're given a 60-day window where you can actually move those funds back into a retirement plan without paying taxes or penalties. But you don't get more than 60 days, so it's very important you get it done in that time frame. But yeah, I mean, on a good day, if on someone that works easily, you're probably looking at 7 to 10 days to get it all done. In a more complex scenario, I mean, you might be looking at 3 to 5 weeks.
Got it. And if someone wants to look at the self-directed IRA LLC for the checkbook control, do you guys provide attorney for that service, or I need to work with an outside attorney to get that LLC set up? And then I can move the fund from my IRA, from, let's say, UDirect to that LLC, right?
Yeah, we can create the LLC for you if you like. We charge $1,995 plus state filing fees. The client can also go find their own to get it created for them. So it's just a matter of which way they want to proceed.
Yeah, because if I look at the structure, I think the LLC gives way more control to the money than just keeping it in an IRA.
Well, you haven't eliminated the IRA. The IRA is what owns the LLC. You just have now control of the funds in your own checking account.
Yeah.
But
you have a checkbook. Yeah.
The LLC now. But you're right, it does give you more control. It also gives you potentially the opportunity of making mistakes easier because you don't have parties looking over your shoulder. So if you're going to do that, you really need to have good tax and legal advice, and call us with any question. Don't feel like just because you've got an LLC that you're no longer able to talk to us. You're still a client of ours. You're still going to be paying us an annual fee if you use an LLC. So definitely call us and ask us any questions.
Yeah, that's exactly what was going to be my next question, that if I do an LLC, I can still reach out to you guys for legal or compliance questions, right?
Well, not really legal questions because we're not able to give legal advice. So
right.
It's about whether or not your LLC can invest in a particular type of asset class. I mean, there are some questions we can answer and there's some that we can't. And if we're not able to give you an answer. We'll tell you what type of person you should be looking to get advice from, whether it's legal or accounting or whatever.
Got it. No, I think, that's all I had.
Okay.
Hardik, if you have any other questions. If not, I have it recorded, so I'll put it in. If anyone wants to reach out to you, I'll, introduce you to them, or they can, of course, always reach out to you directly as well.
Okay. That sounds great.
Thank you so much. I really appreciate taking the time out of your weekend. Thank you.
You bet. You have a great night, too. Take care. Appreciate you letting me be a part of it. Okay. Bye-bye.